All right. Well, I'll kick us off. Uh, Welcome, everyone. I see that people are starting to file in. So thank you for being here today and taking the time to engage in this conversation. For those who are just joining their first Fireside Chats, these are an opportunity to dive into some complex topics, have some discussion, and give you the knowledge that you need to ask the right people the right questions. So today's topic is on capital markets. We're joined today by Shirley Speakman at Cycle Capital and Marty Reed at Evoke Innovations. They're our expert panel for today, and they're going to dive into the first of all, the topics of capital markets, some of the events that are going on right now, and how that applies to you, your business, and your fundraising strategy. On top of that, we have James Chapea, Foresight's very own, joining us today as well as the moderation of the conversation today. So thank you, Shirley, Marty, and James. Thank you so much for being here and for all the insights you'll have for us today. Without further ado, I'm going to pass it off to James, and he's going to kick things off.
Hey, welcome. Shirley, Marty, thank you so much for joining us today. This is arguably probably the most important topic facing companies today. Everybody needs to raise capital, but what's actually going on in capital markets? For everybody joining us, what we're going to do is I'm going to turn this over to Shirley and Marty, who is just going to have a discussion. They're just going to talk to you guys about what's going on for probably roughly around 30 minutes or so. And then we'll get into some questions after that. Please put your questions into the Q&A session below, because some of those will be able to address. Each of Shirley and Marty can, or myself will be able to address some of them just directly to you, or we'll bring them up as we're going on. So please take advantage of that. And without any further ado, Shirley, Marty, welcome. Turn it over to you guys. What the heck is going on in capital markets?
James, if I knew the answer to that question, I'd be a millionaire. So from my perspective, I'm a senior partner with Cycle Capital, been there for 7 years, and I've had a pretty good background in venture capital. Actually also saw the dot-com bubble era as well. So that kind of dates me. I probably shouldn't have said that. But, it is a very unusual time. From my perspective, valuations, part of venture capital is making sure that you can see how the math works, right? And then layering on the math, your history and your experience with transactions and how things can go bad and how how things can go well. And there's a number of deals recently where I've been penciling out the numbers and the expectations of co-investors or the lead and around. And I'm challenged to figure out how the venture capital math works.
Yeah, I think similar background to Shirley. I moved to the Valley in the 90s, was like literally at the epicenter of the dot-com era at a dot-com in 99, 2000. Also was sort of firsthand to, let's call it the clean tech 1.0 bubble between kind of 2007 and 10 roughly. Things have gotten frothy. We're starting to see a lot of folks come into the space that would be sort of traditionally generalist or sort of more classic tech investors suddenly coming into our markets. And then you've seen corporates get much more active, almost all of them now, once you get above a certain size, market cap employees, but they're starting to get much more active. And then this sort of wild card that I still can't figure out what the heck, how this is going to play out. The Brookfields, the BlackRocks, with $12 billion funds, all looking to do, quote, ESG and energy transition investments. That's a lot of capital and chasing fewer deals. And so we're starting to see timelines compress, meaning just take less time to raise a round. To Shirley's point, valuations, both of us been at this game a few years, and you start to ask yourself, well, is this priced for perfection, or is this just unrealistically priced? I guess one other one, and then I'll pause, which is, this isn't universal. So within energy transition or clean tech or ESG, if you just call yourself green hydrogen, suddenly you've got a bit of a premium. It's jokingly, like 5 years ago, you just had to say you were doing AI, and everyone was like, "Oh, it's AI, it must be good." But there are certainly still underlooked aspects, particularly in, when you start looking at industrial efficiency and how do we improve the steel sector, concrete, these are still tough sectors. And I think you haven't seen that same euphoria quite hit all of those markets just yet. Although an example or two like Carbon Cure, where certainly there is a lot of enthusiasm, I will say that.
So when you look at that, and one of the points you made is valuation. So you have these big funds coming down market. Pricing becomes less of an issue because they're looking to place capital. So and from their perspective, they need to place a lot of capital. We saw a little while ago, we saw Transit Security, which was, I think that's the name of it. They raised $543 million on a Series A in a $2.2 billion pre-money valuation. Now, from your perspective, you'd see some would go, "Oh, this is fantastic that I'm getting that much money this early." But doesn't that create, like, from an early stage company's perspective, doesn't some of that also potentially set you up for a problem if you can't catch up? How do you manage that? Because you're managing these funds and you're needing to place that capital. So what do you look at in those situations?
So James, from my perspective, there's a number of ways to look at that question you've just posed. I mean, one way to look at it is, if the company actually raises all the money it ever potentially needs, then, kudos to you, right? It's kind of like the SPAC market. The idea being that you raise absolutely every amount of dollar that you could possibly ever need. And that way, if you don't execute to perfection, no harm, no foul. You still have the money in your bank account, right? It's where you're not raising all of the potential money that you need in order to execute. And to give yourself the buffer room for the mistakes or the growth opportunities that will inevitably happen. And it's kind of hard to go to a market and say, I haven't actually delivered, but I'd like to go out and raise more money. And by the way, I'd like an uptick from this valuation, because your existing investors certainly won't be happy. I think that, these funds that are putting dollars in, let's face it, they have to put at a $12 billion fund. It only makes sense if you're writing a certain size check. And you also certainly don't want to be you can't go above a certain threshold when you're writing that check. So that automatically means that as those players come down market, the check sizes get bigger and bigger. And if you take a look at somebody like Tiger, who's writing who's doing 1.3 deals a day, you gotta know that they're actually not giving you the time and attention you're going to need in order to execute to perfection, right? Or perhaps not getting all of the networks benefit that you would hope to get. So I think it's kind of a two-pronged approach from my perspective, which is, are you raising every last dollar that you possibly could imagine? And then, okay, go have fun. And if not, then you need to step back and think hard about, am I setting myself up to not be able to raise a next round? Because it really is about your ability to execute and to show value in order to get the uptick in the next round. I hope that answered is that helpful?
Yeah,
Marty?
Absolutely. Marty?
Well, Shirley, I mean, we've both seen, thousands of pitches in our lives where the entrepreneur has said, this will be our last fundraising round. They're wrong 99% of the time. So just as an entrepreneur, be cautious and realistic, because inevitably you probably are going to need more capital than you think. The other comment I'll add with these valuations, this may be a bit counterintuitive, but my experience, you raise a round today at this valuation, and it's frothy, and it's sort of it's beyond what we would normally expect. Fast forward, let's just say, 2-3 years and the markets have turned, and now, you've slipped, stumbled, which is not uncommon for early stage companies. Your ability to do a down round, meaning, a valuation below where you were before, is very, very difficult to do. And what ends up happening, probably as many times as not, is that company will end up just shutting down. And you would think that the investors would be more than happy. All right, well, let's just knock it down 10%, 20%, whatever. But for a whole host of complicated reasons, it's really tough. And then new investors coming in don't want to see a company that's doing this. So just when if you're an entrepreneur and you're thinking about how do we take advantage of this market, just don't get too over the tips of your skis, because not to make too many skiing analogies, but it's hard to recover from a yard sale. Your kit's spread out all over the mountain. It's tough. Better to take it a little slower, and think about ultimately the sort of long time frame that it's going to take you to get to whatever your exit is. So just be a little cautious about getting too excited or too greedy on valuations.
Barry, it's a great point, because my experience with yard sales is they only happen underneath the chairlift and everybody gets to see. So it's not like they happen in the backcountry where it doesn't really matter. This is front and center, and it's not a good position to be in. So good point. So managing this, even though it's frothy, isn't taking from you guys, it's not necessarily as easy as just saying, okay, I'm taking all the money I can get at this valuation, because you may set yourself up for the next round. But I'm also seeing some of the things, and want to get your comments on terms that you're starting to see come into this frothiness. For instance, I've seen some of the companies talking about the investors providing term sheets that have syndication restrictions, where it's like, you know what, if we're doing this, we're taking 100%. I have no friends right now. And doesn't that create another set of issues where you could have a problem?
Well, absolutely, James. Yeah. I mean, but if you think about it from their math perspective, that's absolutely what they have to do. They have to write a check of a certain size. They can only take a certain amount of ownership, and they want to make sure that they can set themselves up for taking up that much for the next round and the next round and the next round. So I understand why they're doing it. But my experience has always been having more smart people around the table, as long as they're the right smart people, is better for the company. It's been my experience that not every venture capitalist is the right venture capitalist for a company at every stage that it goes through. And there's a transition. And you need, from my perspective, to have the right bums in the seat to help the company at its various stages in its life. So we love to syndicate. We love to syndicate with people that we know, people who have different skill sets than we have. We also syndicate with industrial partners, because we know that they add value. We do it in a particular way to minimize their influence, but you get the right people around the table and it actually accelerates growth.
I think we're pretty aligned. I mean, James, I would describe that as a function. It effectively acts like leverage, meaning venture firms setting terms that give them more control, ability to deploy more capital, et cetera. And leverage can cut both ways, meaning if it's just an up market, it can work to their advantage, but in a down market, it hurt just as much. And so our view, I think similar to Shirley, I like to keep our deals as absolutely vanilla and plain as possible. We prefer to syndicate, other than occasionally at the very earliest stage where it just doesn't make sense to have a whole host of folks around a table. But certainly by the time you get to A, although now, seed is the new A, or whatever, A is the new whatever. Seed deals have gotten a little bigger lately. And so, probably now let's start to think about a full syndicate at a seed stage. But yeah, to Shirley's point, I've never once looked back in hindsight and been like, man, I wish there weren't more smart people at this table. Like, it's good having folks that have been through the cycles with you through this journey.
you guys actually both raised something. Shirley, you started this on the topic about how the corporate VCs and the industrials are playing in this. And Marty, you manage this situation every day because of who's behind you. Now, is there differences taking place in current market situation where you're seeing that from, like, typically the large corporates don't tend to lead deals themselves, they tend to participate, but obviously managing the risks and the interests of the financial investors versus the industrial investors or the corporate backed VCs is a challenge for these guys. And because their drivers are more, the corporates are more on the getting access to the technology and so forth. And obviously the financials are more aligned on generating financial return for the company and shareholders and so forth. Are you seeing things happening differently in capital markets today on that dynamic between the corporate and the VCs, or is that still pretty standard?
Well, maybe I'll start on this one, and I could probably do an entire session just on corporates and how they play, and I want to put them in a couple of different buckets. So, like Evoke, our first fund is backed by Suncor Cenovus, but we are arm's length, and so act as a bit of a hybrid between corporate and financial. And I'll point to some of our friends here in Vancouver, Pangea, who similarly have a number of strategics investors behind them, but again, act kind of arm's length. Then there are the corporates that have been doing venture for a long time, and I'll use Shell as an example. Shell has a venture team that's been around for ages, and they have professionals that come into venture, and that's effectively their career path. What I still see are corporates who are like, well, there's this whole energy transition going on. ESG's become a thing. Let's quickly stand up a venture arm. They take, their VP of operations, and suddenly that person is now a venture lead. They've never done a deal before. And so there is just a huge variation in strategics. As a general rule of thumb, take whatever they promise you in terms of customer access, credibility, and cut it by about 95%. Not to imply that there aren't strategics that are great and bring real value, but oftentimes it's just not the case. Also be cautious around mandates and teams. Again, folks leading corporate venture oftentimes are on a corporate rotation, so they'll come in for 2 years and then they rotate out. So you, the entrepreneur, you're constantly trying to find new internal champions. And then I generally think corporates should not lead rounds because they lack the kind of financial discipline. It sends the wrong signal to the market. So, we're seeing them in more and more deals. The Canadian Venture Capital Association published the numbers, and James or Shirley may know this, but I think there's now corporate participation, like, it's approaching 50% of deals, something like that. So they're very much out there. They're active. Just as an entrepreneur, I always recommend trying to balance out your rounds with a financial investor and a strategic. If it's just strategic, it's tough. So.
James, let me add on to what Marty said there. I think that one of the things he's highlighted is the nature of what a corporate is, right? As a VC, this is my job. This is what I do, right? This job, and then my next job will be to get the next fund going, right? So there is no misalignment, I think, from expectations perspective. That's the first thing. And the next thing is we always reserve for all of the companies in which we invest. We always do that. And it's because it's just the right thing to do, right? So it's sometimes challenging when you're going for your next round of financing and you have a conversation with the new head of venture at XYZ Corporate, and he goes, well, that's not in our budget cycle this year, right? So I'd be happy to invest next year, but the reality is that I need to invest this year, and I need to have this done in a certain amount of time. So you really do need to understand the nature of the beast. And there, as Marty pointed out, there's some good corporate venture funds who actually do act like corporate venture funds and have some of the rigor and discipline and processes. There are others who just don't understand it. And it's important to know the difference.
Oh, I could not agree more with you guys, because I've personally seen no budget, and then they signal to, like, they're intentionally or unintentionally, they send a signal to the marketplace and the whole thing blows up in your face. So I do want to, there is an interesting question that popped up, and it deals with something that I've been interested about, is the nature of venture capital in Canada versus the US. We've seen parties that say, well, you have to go to the US, you have to do this, you have to move down there to get the valuations that you want, to get the access to capital that you want. But I've also seen now a movement with some venture capitalists recognizing that they would rather keep CCPC, a Canadian Controlled Private Corporation, Canadian control for access to SR&ED and all sorts of, because of the amount of leverage that's actually available to them in that. What are you seeing now with respect to this? I think it's very important with respect to how capital markets are currently functioning. Do you need to move, or can you function here? What do you see?
Interesting, James. I have a company that we're looking at investing in who's actually looking to move from another country to Canada because they've heard about the Scale AI, they've heard about Mila, they've heard about the SR&ED. So there are people who are looking to move to Canada. But these are companies that require that type of support. So I think from my perspective, I don't think you need to go to the US. I think that there's lots of US investors who are looking to Canadian opportunities. But that could be a biased view because of the nature of the companies in which I invest. Maybe if you're a fintech company, you got to go down to the US or New York or wherever it happens to be. But I know the type of companies that I invest in, I haven't actually seen the pressing need to move to the US, given the amount of interest that's coming towards Canada. Marty, what about you?
Yeah, well, and so I'm a dual citizen. We've got my partners in Silicon Valley. I spent the bulk of my career down there. And so I'll offer just a couple of points, which is within sort of the climate, clean tech, ESG space. I don't know, Shirley, there's probably 10 firms in Canada, I don't know, plus or minus. And I think in climate/ESG, there's 250 on Sandhill Road in Menlo Park alone. And so just, there is a scale of the market which suggests that at some point, if you're going to raise capital, just odds are that they will be US. I see no advantage, however, to relocating your company down there, not for capital. Capital is largely mobile. What I do think is important is identify where the best talent is and where the customers are. And maybe you have your founding team here, but then you set up a center of gravity, a second office, if you will, in another market, wherever that may be. But it should not be for access to capital. That good companies are getting funded up here all the time.
And that's exactly the point that this company that's looking to move to Canada, they're looking at the support. They're from a government support of opportunities from SR&ED, but the talent and the press, the initiatives that are underway, the talent that's available out of universities. So I completely agree. It's the one thing about capital is it's fluid, and it will find the best opportunity.
Okay, so question for you then. How do you, in this type of market, if you're a company, and we always know you want that warm introduction to you guys because you'll see 1,000 different ideas in a year, and how do you sort through this mess of stuff? And we won't even today get into the topic about how to make sure you're putting your best foot forward as far as being, because I definitely love that topic. But how do you get access to these parties that you may be on their radar screen, but how do you move that needle to take you from where you're at today to getting your guys' attention?
All right, we'll tag team who goes first. I think this is a good question because, like, sort of your prior question, if suddenly you're like, you know what, I'm just going to move my company down to Sandhill Road, and then suddenly I'm going to have magical access. Like, that just doesn't happen. And so I would say getting in front of me is no different than getting in front of folks like that, and building out that network is critically important. Obviously, there's a lot of resources through Mars, through Foresight that can help with those intros. The other one I'll say, I think startups undervalue a great independent board member, which is something companies can start to think about early on. It's not a huge bar for, bringing on someone, meaning like you're not giving up huge chunk of the company and big capital and cash outlays, but having someone like that brings credibility and can make intros on your behalf, hugely valuable. And then you do have to get out and about, meaning I realize the last year and a half has been a little awkward, and Zoom, networking is different. But, I'll point to an event that we've done every year for 15 years, but, the Clean Tech Forum, San Francisco, like if you're trying to raise, that every year there'll be 200 investors at that event. And so if you're serious about raising and you need to build your network, get down there, full stop.
So are you better off on that? Sorry, Shirley, go ahead.
No, I totally agree with what Marty said. And I think it is, if you step back and you think about it, I can't be successful as a VC unless I get an opportunity to see great companies. So theoretically, it shouldn't actually be that hard to get in touch with me. My job is to to make sure that I'm accessible. I think the reciprocal is that your job as an entrepreneur, any job as an entrepreneur or CEO, is to make sure that they're doing what Marty's talking about, is putting the work in to making sure that you get access, right? And I'll just want to reinforce Marty's point. Some of the best companies that we have independent directors, and they brought in the independent directors early. It keeps the venture capitalists honest, right? A good independent board member does that. But the halo effect of these individuals can be quite substantive, and it shouldn't be underweighted how important that can be.
I could not agree with you guys more. It's funny. I got this kind of comment that I put out there. I say, companies see investors as I characterize them as lazy, ignorant, and greedy. And I see the investors looking at the companies and saying, well, you're lazy, arrogant, and greedy. And so you got this battle that goes on between these two. And it's like, I could not agree, Marty, with you so much. Do the work, get this out there. And that whole point about to me, I think it's all about team. And whether that's like make sure the board, like everything counts. The board, the proper team, the telling the message and so forth. Now, just wanting to pick on something for a second. Do you guys have, like today, I know one of the things that would be problematic from your guys' perspective, you see a lot of companies think, well, I'm doing a seed round and I'm only going to need $100,000 to $200,000 or $500,000. You talked about earlier, well, you guys need to place capital. So those things become problematic, is saying I can't waste my time on $100,000 round like that. You're just too early for this marketplace. On the other side, so you need to place a certain amount of capital, and as you said, you reserve. So you're saying, well, I got a certain amount that I'm going to put in the future. What do you see as making sure that companies set the right strategy for recognizing they're not funding a project, they need to fund a plan, and saying, I'm doing here's my series, maybe I'm doing a seed right now, but my series A would be at this point, I'll be doing, de-risking things. How do you see that as setting up a strategy to present to you guys with respect to how that funding works for, say, maybe you're doing a $2 million seed, but that you're going to be doing a 10 million series A in 18 months or so forth. Thoughts with respect to strategies and communication on those things?
From my perspective, it's all about reverse engineering, right? So if you're going to do a series A in 18 months, know what you will have had to deliver. Make sure you're raising the right amount to that. And then, okay, assuming you raise the $10 million series A, or what are you going to do with that capital to get you to the series B? So it's the same thing, just reverse. You can do the math backwards. What will I have achieved that makes me valuable to the series A investors? and how much do I have had to raise in order to achieve those objectives. And that way you've got that plan laid out. Here's the dollars, this is what I'm going to achieve. Here's the dollars, and this is what I'm going to achieve. And I've proven that I can achieve what I say I'm going to do.
I'm going to piggyback on that. I'm going to tie in an earlier question from Ian. So I never believe in external valuations. I don't think I've ever used one once, other than there is a requirement to properly price stock options, but that is totally separate. And so literally never used a third party ever in my career. Go back to the seed stage, use simple venture math on your valuation. If I'm coming in and writing a $2 million check, I probably want 20% of the company plus or minus. So there's your valuation. I also want to be equally clear to what Shirley said, which is around, all right, what are the boxes we have to check to then be able to do that Series A? I also want to know, what are the gaps? I hate a Series Seed company who comes and says they've got everything. Like, be transparent. Like, what are your challenges, your weaknesses, strengths on the team? Because, we're about to enter into what will be a 7-year relationship, which is generally, if I'm investing with you at the seed stage, how long that'll take. And if we can't collaborate at the earliest stages, it's just going to go downhill from there. So be collaborative, be transparent, because also we want to bring value. And if your weaknesses don't match up with where we can bring value, then we're not the right investor for you. So let's make sure we're clear about that. So.
And that was building on what you said and what Ian's question was. One of the things that I've seen very problematic is that you'll have the companies that'll say, I'm not at your guys' stage yet, so I'm doing with angels, I'm working on this thing, and just look at how good I was, look at how high evaluation I got, and then they set themselves up for a down round. To me, it is not about the project, it is about the entire plan. And if you don't know the steps that you're going through, and as you said, I think it's absolutely, I've stopped using words like milestones and objectives. Can you just tell me what questions you're going to answer? Because those will help you de-risk the company. And let's just keep it simple, guys. So to me, that's super important. Okay, so I know I will tell you what's going to happen. I'll tell you when it's going to happen, but I won't tell you what went together. So obviously right now we've got ourselves into a frothy market. At some point, this is going to correct. It will move to another thing. How do you guys see, what's the number, say 3 things that people should be making sure that they're doing in this time, besides taking advantage of the market and raising capital when you can? What else should they be doing in that process as far as managing the risk? Because that's one thing no one ever talks about. There's risk that's going on here. So thoughts on that?
Know your cash runway. That's because you're going to be raising at a certain valuation. Know how long that's going to last you. I am always shocked when people don't have a good handle on that, right? So, and the sensitivities around that. So it's going to last me 18 months. And then I start asking questions like, okay, but that's contingent on what factors? Okay, now we've worked. And okay, so what happens if the 2 of those 3 factors don't come into play? What happens to your runway? So you really do need to, from my perspective, understand your operations and what the drivers to those operations are, and demonstrate to me you have a great handle on what those metrics, what those dials and levers are, and importantly, how you would react to those dials, to the factors that come into play.
I'll offer, for those not old enough to remember, go back and read Sequoia Capital's RIP Good Times. It was a pretty seminal piece back in 2008 that sort of took a look at, hey, here's this banking crisis, but we think it's going to impact venture and what you should do about it. It's funny how things come full circle, because at some point you may see Sequoia just blast that out again. Just a couple of things, and again, some of them have been mentioned before. Like if you're bringing on capital today, make sure those investors have capital reserved for your next round, because inevitably in a down round, a lot of investors disappear. And what usually happens is existing investors will just support their portfolio and aren't looking to do deals. And so that makes it challenging. The other that I worry about enormously in markets like this is your ability to secure a team.
Yeah.
Like right now, like every company I talk to, it's like, how are you going to hire? And if you can't put that team together today, just when the inevitable downturn hits, you're just not going to be well positioned. And so I think, James, you said it all comes back to the quality of that team. You don't have to have it all in place when we come in on that, whatever it is, Series A, but we better be clear as to, all right, here are those gaps and how we're going to fill them. And boy, perhaps as much as anything, when I look at a CEO, their ability to hire amazing talent is really kind of what we look at as a leading indicator.
Yeah, they never teach you in school like what the job is of the CEO, and I keep harping on it. It's like set the direction for the company, right asses in right seats, and make sure you don't run out of money. And other than that, the job's pretty easy. But the fascinating thing is that most of them that's not the way they are, and that becomes that huge challenge where you're adding risk to this, the risk to the equation. I'm interested from your guys' perspective, like, so how we got here is, it appears to me that we had COVID hit, we had all capital choked down because they were reserving it for their portfolio. So no one was investing in anything for a period. And then it was like, oh crap, like there's a lot of opportunity that we need to be placing this capital. And it seems like there's more and more capital being pushed into the system. So we got deals being done, maybe not the greatest of terms. We got some interesting new terms that came into play for some. And now we're hit the point where there is a lot of capital, less terms. We have the big guys coming down looking for opportunity to find a place it. But one of the thoughts that I've been seeing too is, are you seeing this double edge or the squeezing taking place where people that used to invest in seed are going up market, or are they staying in the seed? Are you seeing different dynamics from different investors in the capital markets on both ends? And how is that playing out in how people behave with respect to companies and investment opportunities?
Marty mentioned something earlier, right, which was that this froth isn't happening in every sector, right? So if there's one thing that I'm seeing, it's that people are recognizing that the space that they've traditionally played in, maybe, it's getting crowded. So let me give you a tangible example. There's a high net worth individual that I know who used to do seed and early stage investing in venture. They've just said, I can't do that anymore. So I'm going to go into private equity. he's actually he's coming up, right? He's saying I can find a good little manufacturing company that's spinning off EBITDA. I can, maybe I can do some leverage on that, and I'll get dividends off of that. So, and I'll get a good return. So to the comment I made earlier, capital is fluid and it's going to figure its way, right? So yes, there is a dynamic change. Some early stage investors are moving out because, let's face it, they can't write the checks. They're not, if you're going up against somebody who's like a Sequoia or some of these other who want to write really big checks and want to keep it all to themselves, you do get squeezed out. But ultimately you have to find a different place to put that capital, and capital will find a place to go.
So are you then creating this risk of maybe bringing in that as the capital is playing out? I think, Marty really touched on this, where you're getting investors that put capital in and maybe have absolutely no idea what they're doing. And I don't, there is this concept of dumb money. I don't mean to make it sound derogatory in that respect, but it's maybe it's not bringing anything more to the table that creates risk later on down the road, where you go, well, they didn't know what they were getting in the first place. And so, to, like Marty said, this is a relationship that's going to last years, not days or months. And if you don't have that knowledge of what you're doing with it, did you just set yourself up for another potential problem?
Yeah, I mean, we've talked about it, which is inevitably there will be some normalizing correction. I don't want to use that term. Within the life cycle, anyone listening doing a seed or A, you will almost certainly see that happen within sort of your horizon. And so really understanding who those investors are, what their track record is, how long they've been in the space. We've certainly seen, as with our first fund being focused on, sort of pre-seed and seed, we've looked at deals that we were fairly excited by when all of a sudden those jumped up to, $20-30 million seed rounds. And we just said, well, we're not going to participate. And so that's, for someone like Evoke, I think the other important question that you should be asking your investors, kind of where are you in your fund life? Anything less than sort of 6 years left or 7 years left, even on their fund life, like be nervous. Historically, private equity funds would oftentimes have a much shorter, sort of 7-year window. They're at year 3 coming in on a, Series A deal. Like, I just don't understand how that math can ever work out. So I think it's just both sides, both investors and entrepreneurs need to do their due diligence and just make sure it's the right fit. Don't try to optimize for valuation, try to optimize for outcome.
It's the best advice anybody could give.
So on that basis, then, say you just did a raise today and like you've just completed it, you've raised what you thought would get you through 18 months. Okay. So, but now should you be actually looking at this and going, hang on for a second, if I'm a seed or a series A, it's to Marty, I think to your point, it's likely that there's going to be a change that takes place in the marketplace at some point in the near term than later term. We can't call when it's going to happen, but could you see yourself maybe needing to readjust and say, maybe I should be re-looking at this and potentially saying I'm going to need to get maybe farther out. If that does take place, I could be in a real problem. Or are you just saying if you're really good and you've executed, it really won't matter at that point?
I mean, this is I think Shirley started out like, boy, if I knew the answer to that question, I'd be a retired cajillionaire now. Fully transparent. Like I've got a portfolio company where we were going to go out and do, let's call it a sort of classical Series A, based on interest in sectors. Suddenly that is going to be a mega Series A, and we are very much asking ourselves, like, have we now given ourselves enough rope to completely hang ourselves? Frankly, only time will tell. But in this case, we were very thoughtful before doing this round, asking ourselves, okay, let's kind of game theory this out. What's going to happen if the market downturns? If this, and felt comfortable doing it. We're bringing a number of strategics. We think there's a pathway to M&A, as opposed to having to carry this all the way through to either free cash flow or a public exit. And so we kind of reverse engineered it and said, all right, yeah, let's bring this capital on right now. In general, if you're talking about going just high level rule of thumb, for which of course every rule of thumb is wrong, if you're talking about going from raising 2 million to 4 million or 5 million to 9 million, like, great, fully supportive, let's do it. If all of a sudden you're like, hey, let's go, instead of losing 4, let's raise 40. Like I'm not sure that's the smartest path. So
it requires a completely different organization, doesn't it?
Oh, for sure. Like I don't know you could hire that many people, and where are you placing that capital? And that's just it, is what's the plan to use that thing? Now, Marty, you'd actually talked about something there that I really want to go into, because this isn't just access to capital as far as dollars. These types of changes in market do affect M&A activity as well. And could you actually see yourself saying, okay, recognizing that this is likely to happen, there could be a case where there'll be those other companies that say, maybe some of my competitors, maybe some other things that are out there, maybe they don't execute properly. They don't actually get the capital. Could you see this as a real opportunity for saying, I'm make sure that I can get through this, and I can then say, I could potentially execute on some M&A as well? Are those things that you guys like seeing? If it's like, I know you want to organically grow things, but if there, would you also build companies on the inorganic or the M&A way, or are you looking more on the sell side at that point? What's your thoughts? And Shirley too, I want to know what you guys are really thinking about that.
Oh, I think early stage companies trying to do M&A is just unbelievably risky. Once you hit a critical mass, and that critical mass is probably, you've got north of 100 million in capital to play. Okay, then let's talk about it. Anything prior to that, it's figure out how to build one business before you start trying to tack on other businesses. Again, there's an example out here in Vancouver, a company, Semios, they raised 100 million. They hired a really top-notch leadership team with that 100 million, and they just raised another 100 million to now go do M&A. Okay, great. But if I've got a portfolio company who comes to me today and is like, hey, I want to start doing a bit of a roll-up strategy, like that, it's just a fundamentally different team. I'm not sure I've ever seen that work successfully. Again, at anything below about $1 billion in market cap. So,
okay.
Yeah, I completely agree with Marty. It's tough enough to build a company at an early stage, and the dynamics you have to play with to layer on the complexity of integrating two teams, two organizations, the cultures is just really hard.
Hey, James, can I flip that around though?
Yeah.
Because what I do predict, and man, I have never had so many bankers reaching out to me, exploring my early stage portfolio. You are seeing corporates who are suddenly saying, holy cow, we suddenly need to be energy transition or ESG, and they have no idea what they're doing, but they've got these enormous balance sheets. And so I think you will see record M&A over the next kind of 3 to 5 years. Just as companies are saying, listen, we've got to get out of this old legacy business, whatever that may be. And the only way to move over here is through an acquisition. So we are literally having bankers call us on small companies, and 90% of them, they're just too early, but I think that's going to it's going to continue to heat up.
And Marty, what do you think that means when we have companies going public for billions of dollars? Like, I don't know a public company that's willing to pay what some of these de-SPAC companies are securing, right?
Weren't you an investor in ESS?
I was, yeah.
I won't comment good or bad about ESS, but I think that's a great example. Obviously, a good outcome for you, and I know Pangea is an investor there.
Yeah.
But if I had told you 2 years ago, hey, Shirley, we're going to take this company public, you would have said, you got to be smoking something. Obviously, I think it's a positive sign. I've talked to every banker out there, like, what do you see coming? They all think it was, a bit of an anomaly in 2020, first half of 2021. There is more of an appetite for these types of public offerings. It won't be what it's been. I think it creates nice pressure on the M&A side, meaning if a company like ESS has a potential pathway to public, it makes it frankly more likely that a big, corporate may come in and acquire them. It just, the more possible pathways you have, I think the better. And the fact that public markets are there now, it's great.
And I think one of the things might be that they come in sooner than you might have thought that they would on looking for an M&A, so that it prevents the companies from going out and doing the IPO, which makes them priced out of their acquisition range.
So that's an interesting, okay, so typically when I take a look at companies, and obviously, IPOs tends not to be the way a lot of the companies end up going, just because the size you need to get there. And then, to be of important enough that you're getting research coverage and you're getting trading and all the things that you need to be there. But M&A definitively. But are you seeing the large corporates? Because obviously the bankers are coming and start pounding. Are you getting them coming down to smaller companies, or is this a case where they're still maintaining the discipline on the acquisitions front? And I know it's going to be hard to tell exactly what happens in the future, but I get the transition, the energy transition that's taking place, especially on the clean tech side. So thoughts on, are the acquisitions turning to be smaller than they historically have been, or not really?
No, I just think the window is opening sooner. Full stop. Meaning, again, corporate appetite is high in a number of sectors. You're going to see record profits next year. They're trying to think about how you redeploy that capital. You can only do so many, share buybacks. And so, yeah, I think you will just continue to see these opportunities that are available that weren't necessarily there, 2 years ago.
Right.
Now, do I want to take a company public as a guy who's been in publics? No. Do I want to threaten to take my company public to force an M&A? Yeah, that's a great situation. I love that move. So.
Right. That one you'll do every day. It's here's my. If they believe that you could actually do that, then you've got some leverage. Now we're back. We're getting into the last 10 minutes. So what I want to do is in the last 10 minutes say, what would you want to, Marty and Shirley, what are some key messages with respect to capital markets that you just want to reinforce to the audience, and let it open up to any more questions that they may have for you? There are some Q&A in there. I think we've addressed some of them have been directly to each of you, but thoughts, over to you guys.
So my guidance would be don't get caught up in the irrational exuberance at this moment in time, right? Because it is irrational exuberance. I mean, if we take a look at, did a couple of numbers, sought some numbers out, and admittedly this might be again biased because of my opinion, but there were 136 unicorns as of Q2 of 2021. That's 6 times the entire number of at the same period last year, and more than the 128 born all of last year. You've got the second half of 2021's raise is at 139 billion versus the all of last year at 149. So when you start seeing the numbers, you got to know that it's not this. Do you want to bet your company on something that might not be sustainable? So try to be rational and try to understand what you're going to accomplish with the cash that you're bringing in. Make sure you have a great plan for it. And I, as someone who does syndicate, I do strongly support the notion of syndicating. As Marty's pointed out, though, at the right stage. Remember, I'm a Series B investor. We go down to Series A. So we just know having diversity around that investor table adds value. And if there's one other piece that I could add, it would be, VCs, active VCs, not somebody doing 1.3 deals a day, is there to give you something, and you're giving up a piece of your company in exchange for that. My job isn't to be the CEO. My job isn't to go in and be an operator. My job is to work with the CEO and say, what is it that I can do for you today? And if that happens to be, hey, Shirley, can you get me in touch with the guys at Rio Tinto who'll be able to help me do X, Y, or Z? My job as a value add VC is to be able to say, okay, here's the 3 introductions I can make for you, Mr. CEO or Ms. CEO. Now it's your job to go make the most of those. And any good CEO would be able to get into those people. I can do that with a couple of phone calls. It might have taken you 6 to 8 months. And you have to ask yourself, how much is that 6 to 8 months worth?
Time value money. Absolutely. Could make the difference on the company. Marty, thoughts?
Yeah, and actually along those lines, and I was reading some of the Q&A or questions here, and I might tie this in with something Ben had posted. And Ben, I don't know your company, so take this as just a grain of salt and a high level pass. But really, again, do your homework on who's the right investor, for your type of company. Because venture, Shirley and I both represent pretty traditional venture. Like, we go raise a bunch of money from LPs. We've got generally 10 to 12 years to deploy it. And we are generally investing in deep intellectual property and or unique defensible business models that we think can scale. And we are not looking to do project finance, as an example, or helping a sort of waste to value company vertically integrate. Our capital is pretty expensive if you're using that for feedstock, steel, big steel on the ground, that sort of thing. So the good news is, there is every flavor of investor out there now. We've got pretty strong ties in Alberta, and we see a whole host of folks that used to invest in oil and gas and are comfortable with, kind of oil field service companies who are now looking for, these types of companies that might not necessarily look like traditional venture. They're sure as heck not old school oil and gas, and but maybe have some of those same traits. And so, really ask yourself, like, what's the right type of capital here, and how do we best work with investors, again, whatever flavor they are, to try to build a team and move towards a successful outcome.
So, and on the last point, just before we wrap up, so obviously capital markets are doing what they're going to do. They're doing it today. We've got access. Nice thing. That's a good thing. Guys are looking to place capital. At some point, things will change. Ian raised a question here about positioning of advisory boards and to how you guys look at it. I'd actually expand it beyond the advisory board. I'd say, from your guys' perspective, how important is, like, you obviously have to have some kind of technology or project or widget that's out there, but how important is the team in your decision-making process as far as an overall valuation, whether it's an advisory board, that's just a part of the team? Like, when you're looking at making your decisions, what is your thoughts with respect to that? And then I think we'll probably just be wrapping up.
I've turned down great technologies because it had a team I couldn't work with, or a team I didn't think I could work with. Maybe that's the important differentiator, right? So it's important for us. It's quite important.
I think my dogs have just totally agreed with you on that, and we just sent them out to say, could not agree more. Anyways, I'm going to wrap it up and say thank you guys, much appreciated. I don't know if Stephen wants to give a last word. He was able to join us. I need last comments from Foresight, but thank you guys for joining us. It was absolutely hugely appreciated, and look forward to talking to you guys again in the future. Stephen, last words?
Yeah, I just want to say thank you to the panelists. I was only able to catch a little bit, but great advice. It's always interesting to hear the viewpoints from people working in different sides of it. We spend so much time with the ventures. Your view is really valuable. Tyler, we've got our next event coming up next month as well, right?
Yes, next month on November 16th is the next Fireside Chat. We'll be discussing cybersecurity and what it's about and how does it apply to you. On top of that, we also have our carbon capture, utilization, and storage event coming up on October 28th. And we got some great speakers there, and they're going to be diving into some industry specific challenges that they're having. So do look forward to that. I'll just echo the sentiment here. Thank you, Shirley and Marty, for joining us. I think it's been super valuable to everyone, all the attendees, and I can't thank you enough.
Thanks, guys.
Thanks. It's been a pleasure.
Thanks, everyone.
Thank you.
Bye-bye.
Bye now.